If the Fed starts to lower rates in September, what can we expect? And more importantly, who will the winners and losers be?
This is an incredible topic because I think a lot of people are hanging on these quarter point. It seems like a little bit of a marketing and a political play to me.
But we are expecting them to lower rates a quarter of a point in September.
Whoa.
They haven't specifically said that, but they've alluded to it.
Anyway, for all of us, the fastest rates increases in 25 years. So we've all just felt the pain. And thankfully, inflation's now it's about 2.5%, I think. So, and there is a bit of a lag. So it's going to continue to come down. So the quarter point is probably not a bad strategy, but I can't imagine it's going to do much.
Well, you have to think, though, for one, I think a big thing that it does is it signals to corporations, hey, don't let go of your people. Don't, because, as we'll talk about later, we're starting to see higher jobless numbers. So don't let go of anyone yet. Don't worry. We got your back. We're going to be lowering rates, more continually.
The one thing I always say, though, with investing, hope is a bad strategy. So you can't hope, but I do get the quarter point. I get it.
Right.
And maybe and hopefully it's the beginning of several.
Well, and it's right for the election. So you can't fail to acknowledge that. I think, we have to touch on, the unemployment numbers. It jumped to almost 1.9 million on unemployment, which is the most in the last 3 years.
Yeah, I saw that. 2021, I think, was when it got that high. So essentially what that means is more people get more money on unemployment as a benefit than actually going out and finding a job, because it's hard for them to find jobs right now and they can't find anything to get off of unemployment. That's essentially what it means. So while it's not everything, it's certainly an indicator.
Well, and also the jobless claims are starting to go up, and we're at our 10th straight week. It's come in higher than normal.
Right.
So what that means is a lot of people are getting laid off. Maybe they're not on unemployment yet. They're just considered jobless. As you're seeing these trends, that jobless number is an early indicator that the economy is not doing well.
Yeah, we're at 4.1 right now as of, I guess, the end of June. So there's about a month lag, but that's going up. And so you've got unemployment going up, which, believe it or not, the Fed kind of wanted. They've always said low unemployment is inflationary. So what that actually means, I remember when it was like 3.5, 3.7, where actually employers were fighting over employers. Employers were fighting over employees. And so the wages were super competitive. That's good for the employee. I know it says 2.5, but have you seen groceries go down?
No. Well, nothing's went down, but you seem to still be going up.
Well, maybe not going down maybe it's not going up as fast. But I'm certainly not seeing a lot of things go down.
Well, I think it's important to note, though, that the biggest deal is if they cut a quarter point in September, which we're planning on them doing, this is a pivot in their strategy. So they've been holding interest rates higher for longer. And they're essentially accepting a higher than 2% inflation number before they start cutting, which we've seen countries all around the world do. We just specifically haven't done it ourselves.
Yeah, we're kind of last. If you look at the central banks, we're the last ones to do this, which is fine, but there is a bit of a lag. So even though we're 2.5, my guess is you're going to potentially see, certainly rents are going flat. We're starting to see softness there. And that's a big piece of the CPI. It's like over 40%. So I do think that you're going to see the inflation rate go down even more. Problem is, who are the winners and who are the losers as rates get cut?
Yeah, absolutely. And it looks like the Fed wants to cut, right now they're still projecting 4 rate cuts in 2025 and 4 in 2026. So if they were to do this, we want to look at who wins and who loses, because there's definite positives and negatives.
I'll bet somebody $100,000 that is not going to happen. There's no way that they can project through 2026 what rate cuts are going to be.
Well, of course, but that's still what they're projecting.
But
it's showing the pivot, though, that they are wanting to cut rates and they're hoping to get.
I do mind that. Yeah, what they're saying is if they do 5 quarter points, 1 in September, then 4 for next year, let's say that's 1.25. That brings rates down into about 4.25 range.
Yep.
I guess. So that would be great. That would be really good for the economy. At the same time, don't forget what will be going on. Here's what will be going on. commercial mortgages will be fully exposed. And I'm talking about office buildings and apartments and all that stuff. There's massive disruption in that area. The Afterpay, that whole piece, where you're seeing credit card debt really, really, really high, that will certainly get some relief. But a lot of people are financing things right now. They're financing rent, they're financing food, they're financing purchases. And so that will help a little bit. But there is a point where people have to pay that back.
Yeah. So that's one of the first winners, as we were talking about, is people holding that variable debt. So, like you were saying, like with the credit card companies, and Afterpay is a big one. I don't know if you guys know what Afterpay is, but I'm sure you've all witnessed it when you go to buy something and they're like, do you want to put this in like 3 or 4 payments, or do you want to pay it all at once? A lot of people have been doing the 3 or 4 payments on many, many things. So that's starting to stack up.
And what I think you guys need to realize is I have 2 kids in the 20s. They're both in their 20s. And so this is what they're saying to us.
Yeah.
Kids are using Afterpay. This is not something that may be on a lot of your radars, but our son specifically said that this could be what happened to you guys in 2008, right?
Yeah, and a lot of people the retailers are taking advantage of this, right? Like I have a friend that works at Michael Kors. She said, at least 25% of her purchases go on Afterpay, not herself, but from the customers.
You think about that. That's a huge number.
I wouldn't be surprised, if even your luxury brands are doing this, because it's on Afterpay to get the money. It's not essentially on the brands themselves. So, of course, they're going to want to sell to whoever wants to buy it, however they buy it.
And we saw a 12% jump in Flex, which is the company that finances apartment rent. So that's what we saw as a company. So what that means is we get paid from Flex, and then the residents, if they're qualified, actually pays Flex. So we're starting to see these financings happen all over the place, and not just in those 2 spots.
And I also, think that those people can be winners because that debt can, the interest rate on that debt can go down. But those people can also be losers because they may want to add on more debt, if, the economy gets...
That's really what happens. What happens is when rates go down, people stretch a little bit more and they get that bigger purchase. Mm-hmm. That's unfortunately inflationary. Right. That could be inflationary. So the winners of lower interest rates are, of course, all the things that we just saw when rates were low, not just even a couple of years ago, right?
Yeah.
So think about electronics, you think about tech, think about car purchases, think about real estate. All that stuff over a period of time will get a little bit easier. Hopefully that will incentivize people to be able to buy houses again, right? But of course, depending on where their rates are, they may or may not decide to do that.
Yeah. So another winner could potentially be home buyers if rates go down, but we could see an increase in housing prices. So then that would make them a loser. So some of this kind of goes either way, right?
And refinances even, potentially, which would be good for all those commission salespeople, right? Both on the loan side and on the realtor, single family side.
Absolutely. And I think you have to add in, like we were saying, retailers and corporations. So retailers, if debt's cheaper and easier, they're going to have more people buying their stuff, just like we saw lines at, Louis Vuitton and all that stuff in 2021. But then also the corporations, because, they have better borrowing and they're able to kind of move that economy along and benefit from that.
And I think it's important that you guys really understand a lot of businesses, I would say a lot, use lines of credit for stuff. So they are borrowing at low rates from their bank based on, whatever they got as collateral. And as the rates go down, it actually helps them too. So in other words, the corporations potentially can stretch as well, which can also help boost economy.
And construction's a big one that's going to be a winner too, because obviously construction loan is not fixed. So in these high rate environments, it's hard to want to build anything because nothing is fixed for you. Where if things start to go down, construction loans might start to reemerge because they're like, okay, rates are going down, they're not going up. So let's go ahead and start building.
And just to put that in perspective, as somebody who's building, when we started building a project 2 years ago, our rates were in the 4 to 5%, and now they're over 9%. So just by having that come down, let's say a point and a quarter is significant. If it get into the 7s, it saves us a lot of money each month because a lot of interest rates are floating and they float with some other kind of indicator, like the 10-year Treasury, as an example.
Let's talk about some losers. So we've talked about the winners. So one of the losers are going to be people that are sitting in cash or if you're a saver.
That's a good point. Yeah. I mean, I know I was with a buddy last week, and he's got a ton of money in cash just sitting in these 5% treasuries, and he's just cashing in right now because if he can make 5% on cash secured by the government, why wouldn't you just keep it there? And same thing with savings rates. I know a lot of you hopefully moved your money from checking into, let's say, a money market, and you should be getting north of 4%. If you weren't, then you missed that window. But as rates go down, those interest rates on cash is also going to go down. The savings rates will go down.
Yeah, and also home buyers can be losers too. So for those of you, looking to buy a home, prices potentially could go up when rates go down. That's what we think would happen unless there's an abundance of supply that comes to the market. That would be the only thing that could change that.
It'll be a bit of a mixed bag there, but you're right. I mean, hopefully you're going to have some refinancings. You're going to have some new home purchases. You're certainly going to have some new construction, but it's all going to depend on how quick and how quickly is that going to be actually delivered. And then the supply itself. So the more supply, the better the price for the consumer.
Yeah, and then you have to look at inflation too, because all of these, rate cuts are probably going to create more inflation. So that's really hard on anybody on fixed rate debt. That's really hard on anyone that maybe is on a salary and in a job that's not, in super high demand. Inflation, if inflation has been affecting you in a negative way over the last few years, it probably could continue to do so if they start cutting rates.
Yeah, and so that's why you're going to see a quarter point and a quarter point and a quarter point. You're not going to see these 0.50, 0.75 interest rate increases like we saw. It's not going to go down like it went up. So it's going to be slow and methodical and over a long period of time.
And this last one, the renters, this is an interesting one. We were kind of debating on this because, are they going to be a winner? Are they going to be a loser? It's interesting. There's a couple theories of thought on here. So if construction is cheaper and easier and a winner, that could add supply to the market, which would be good for renters.
It would be good. Right now, you guys probably know, in fact, we're starting to see that some construction projects that we started just 2 to 3 years ago, we're renting up. So in other words, there's a big lag with apartments. And you might break ground on something in 2022. It might not be delivered to 2024. It just could take that long. And so those units are now hitting the market. We're starting to see people that would normally buy a home now renting. These are Class A, beautiful apartments, but we're seeing a much better renter that would typically be buying a home. And so that could reverse because I think generally people would want to buy a home versus renting an apartment. It's not always a lifestyle choice. Sometimes it's just, I'm going to wait and see where the rates are going to go because the mortgage payment is so much higher than the rent. It just makes more sense for me to rent in this area. Maybe it's temporary, maybe it's long-term, but I think a lot of people are going to be sitting on the sidelines right now as a result of that. And if rates go down, to your point, there will be more units delivered and the affordability all of a sudden becomes better for the person that's buying the home.
Now, one thing that could change all that is, Biden just proposed national rent control.
I saw that.
Now, this is a long shot to pass. With rent control, you would not get new supply, which would then potentially make the renter the loser unless you were locked into a lower rate.
But look at the other side of it. Like if there is rent control, then there'll be less investment in that area, and most people will probably back off from that, and rents will probably go up.
Yeah, that's what happens. Your most expensive zip codes have rent control.
Yes, right. And they've tried it before. We do need something to help the renter, but rent control clearly does not work because, as we all know, money goes where it's treated best, and it does not go to rent control markets.
Right. Yep, absolutely. Thanks for joining us, and make sure you click on our next video that we did, and it explains how owning a house before 2020 and after, the differences in that.
See you guys.